JPX Energy Market Weekly Updates. Oil prices maintained their gains last week with JPX Dubai, IC Brent, and NYMEX WTI rising for the fourth week in a row as refiners around the world continue to ramp up operations in response to tight fuel market conditions. But the inter-month spread of these crude benchmarks largely remains steady, with the IE emergency reserve making their way to the market. In some regions, a severe shortage of middle distillates, especially diesel, has put a lot of constraints on consumers and businesses. At the same time, major global refining centers are below their peak processing levels, undermining the effort by world governments to lower prices by releasing crude from reserves. In the United States, the national average for gasoline reached $5 per gallon last week, but demand from drivers seemingly undeterred by high pump prices. According to the EIA, U.S. product supply for the weekend in June the 3rd totaled 20,227,000 barrels per day. Among the oil product, finished gasoline demand reached around 9,200,000 barrels per day, which represents the highest level since April 2020. Product supply data by the EIA shows the quantity of petroleum products supplied for domestic consumption. This gave us the implied oil demand. One of the most impactful U.S. gasoline supply was the disruption caused as traders shied away from Russian diesel since March, which took over 500,000 barrels a day of supply from Europe. As refiners and oil traders increased their diesel export to Europe to replace these Russian barrels, U.S. Gulf Coast diesel cracks skyrocketed. The refiners then intend to maximize the yield of diesel at a time when they normally would be transitioning to building gasoline stocks to prepare for the China driving season. In addition, recent tightness of diesel in South America also increases demand for U.S. diesel export. Another reason for lower supply from the United States is a 900,000 barrel per day reduction in overall operable refinery capacity since early 2020. According to the IEA's latest oil market report released last week, U.S. refineries are expected to run flat out near the highest levels in the past 5 years, with run rates averages 94%, while the total feedstock inputs were averaged 16.7 million barrels per day during the third quarter. This average is still lower than the 2019 refinery inputs averages of 17.3 million barrels per day. In Europe, gasoline cracks has more than tripled to $45 per barrel, while the diesel prices reached $182.5 per barrel last week, the second highest level since the Russian and Ukraine war began. Despite the increase in diesel export, diesel crack spread is still hovering around high point of the year. European refiners are grappling to keep run rates elevated in order to meet resurgent oil demand, exacerbated by lack of investment and lack of fixed stock despite very high margins. In addition to the finished oil product, Russian refineries are major producers and exporters of gas oil and fuel oil. These heavy stocks are crucial for processing in the secondary unit of complex refineries. Some European refineries, which were until recently very reliant on Russian feedstocks, have to purchase from other sources. Some refineries also reported facing more logistical delays, which was further complicating the situation. Besides, many refineries in Europe had cut the investment costs in the past few years, which means these plants cannot process at the full capacity for a long period of time. In Asian market, recent bullish sentiment was supported by seasonal COVID-19 related restrictions in China and strong buying interest from Indonesia and Malaysia. On the supply side, despite record export margins spurred by demand recovery and disrupted Russian barrels, China has curbed its oil export, especially diesel and gasoline, largely maintaining the broad policy implemented in late 2021 to limit access to domestic refining in order to reduce carbon emissions. China has released a 4.5 million tons of additional quota on oil product export last week, in a view still weak domestic demand and high stockpiles at oil giants. Up to now, China has granted on a total of 17.5 million tons of oil product export, still relatively low compared with last year. And according to data from the local agencies, Chinese refinery weekly run rates rebound from a 2-year low. But refinery throughput recovery is more likely to be limited as the ongoing COVID control policy may cap domestic demand growth. Since late April, global demand for a clean oil product has contributed to widening of the price gap between light and sweet crude and salt crude. Feedstock availability and cost will be the key focus as crude and natural gas market remain tight. The recent widening of the light sweet crude supply disruptions from Libya also put a pressure on the spread between JPX Dubai and IC Brent, and Chinese crude demand remains an uncertain factor for the spread. In the medium term, our market is and will still be facing headwinds from inflation concerns, but we need to notice that global oil demand is showing the characteristics of a staged structural recovery, with most of the increase comes from fuel demand damaged by the pandemic. However, the petrochemical sector that was supposed to dominate oil demand growth over the medium term remained weak recently. petrochemical margins have turned negative as feedstock prices surge and demand weakens for downstream consumer products due to economic headwinds. And this can be seen in the weakness of naphtha crack spreads. As inflation data continues to soar, it's become more likely that demand destruction rather than supply is the way to cool down the oil price. Okay, that's what we have this week. For more information, please stay tuned to the JPX Energy Market weekly updates.